Jim Rickards, a renowned economist and investment banker, firmly believes that the impending recession will be the worst, with a deeper market bottom than anyone has ever anticipated. Everyone is on the verge of panic. The current market levels are significantly lower than it was last January 2022, and he even predicts that it could plummet further to around 30 to 50%. He adds that the Federal Reserve's plan to raise interest rates to counter inflation might cause an overshoot, leading to a severe recession. This episode is about the state of the global economy, and we need to be well informed. So, make sure to watch until the end for the thrilling conclusion. Today, we'll talk about Jim Rickards' warning about a 40% crash that is bound to happen right after a severe recession. If you're astounded by his statement, stick around and finish the whole video before we get into it. Jim Rickards believes a crash will fall 30 to 50%, around 40%. Most people would use the S&P 500 as a means of measurement, and right now, it sits at 4,000 points. However, Rickards believes this will go down to 2,100 or 2,000 points to understand the situation better. Rickards stresses that you need to know the three sides of the story. First is the Fed story, second is the stock market story, and third is the bond market theory. However, Rickards adds the reality story, which tackles what's going on. The first story talks about the Fed's viewpoint on the market and the economy as a whole. The Fed's main goal is to counter inflation by aiming for a core PC inflation rate of 2%. Core PC inflation doesn't include food and energy prices, a decision that triggered criticism from economists. The Fed's way of obtaining its inflation target is viewed as persistent even if it causes an increase in unemployment rates. The Fed's primary tool for managing inflation is by increasing interest rates. By doing this, consumer debt and spending may decrease, leading to increased demand for goods and, consequently, decreased inflation rates. However, the challenge for the Fed is finding the perfect balance with interest rates. They must use the optimal rate, called the target terminal rate, to decrease inflation rates without triggering other adverse effects. Choosing one that's too high might lead to an overshooting situation where inflation decreases. But as a consequence, the overall economy suffers conversely by keeping the rates too low. The goal of reducing inflation will be far from attainable. According to Rickards, the Fed may tighten monetary policies without realizing they have reached the prime level, leading them to overshoot and exceed the terminal rate. This, in turn, can cause a recession. So that's the Fed story. Let's proceed to the second story, which comes from the stock market. They believe the economic situation is a Goldilocks story where everything appears fine. If the stock market didn't have an optimistic outlook, there would have been a horrible crash by now. The Federal Reserve is hopeful that they will determine the perfect terminal rate and they will soon halt the increased interest rates. They assume that when the recession finally takes place, they will begin lowering rates, providing the economy with a soft landing. However, Rickards stresses that the stock market's belief is nothing more than a fairy tale, and it's so detached from reality. This gold scenario highlights that the stock market is right and the Federal Reserve is wrong. Furthermore, Rickards claims that sooner or later, the Fed will realize the error of their ways, and they'll see the market accuracy, which will trigger them to raise interest rates. He adds that whenever a rate cut occurs, it's an indicator that people should start purchasing stocks. Wall Street even affirms that this is very common. Meanwhile, Rickards says that the bond market's outlook on the economy is more precise in anticipating future events. Each aspect of the global bond market points to an inversion where long-term treasuries have smaller rates than short-term ones. This inversion can be observed in many different countries. This makes the bond market's message understandable and accurate. So, what exactly is an inversion? A signal of Jim explains that this is a phenomenon where short-term rates are considered higher than their long-term counterparts. This inversion is a reliable and legitimate indicator of an impending recession. The recent inversion happened around 2007, a few months before the 2008 financial crisis took place today. The bond market warned citizens that the crisis can cause concern and will likely worsen. Unfortunately, based on the signals, the Federal Reserve can do nothing to avert the problem, according to the bond market, which is directed to everyone around the globe. A recession is just around the corner. So that's the bond market story. Now, let's move on to the real-world story, which talks about what's happening to the rest of the world. In Rickards' point of view, the Fed will only keep increasing rates in their attempts to lower the effects of inflation, and this will happen whether we like it or not. He further explains that we are already at the terminal rate, which means it's not advisable to keep increasing rates. This goes to say that the Fed's to raise interest rates is incorrect, as this will only drive them to over-tighten, which will worsen the recession. With this, Rickards believes that impending recession won't be ordinary. It will be severe when the Fed finally realizes the economy isn't doing well. They might make rash moves for all the wrong reasons if the Fed cuts rates. This is not because they're creating a soft landing for the economy. This is because they're messing up like they always do, which they've been doing since 1913. They tend to over-tighten, which Rickards believes is bound to happen. He stresses that we won't be experiencing a Goldilocks story with a happy ending. The market has gone through several rallies since it last plummeted from its peak in early 2022. It decreased in June, but it rallied again in August. It went down again from August until December. This makes everyone wonder if these rallies will take us back to new highs or if they are short-lived blips as the market collapses. Rickards believes the latter is more possible and that the rally will likely happen in January if the recession worsens more than ever expected, and the bottom will be lower than most analysts would expect. According to Rickards, what we're looking at could plummet to around 30%, and we wouldn't be shocked if it goes lower to 50%. We're looking at S&P 2000 or 2100. So here comes the big question. What are we supposed to do about this? What can we do to prepare ourselves? A lot of investors will tell you many different things. Michael Burry would most likely short the market. Warren Buffett would buy stocks, which he often does. He also holds large portions of cash. However, Rickards looks forward to selling stocks and looking into assets that do well during recessions. Rickards highlights that you should do this immediately and not wait until the Fed figures this out. He further expects that around May or June, everyone will be preparing for the upcoming recession. His point focuses on the idea that the predictive analytic inputs were directed to that conclusion at present, and it would have done the same thing back in the fall. Rickards further stresses that we should prepare now because it'll be too late to sell when the recession finally hits. Rickards also recommends diversification, but he doesn't mean this in stocks, but through asset classes. He prefers relevant asset classes despite whatever the market is going through. For example, the energy sector, which will always be needed whether the market is struggling or not. Natural resources like animal products, oil, minerals, wood, and more are also some of the assets that Rickards believes are relevant no matter what the condition the market is in. One notable investor who believes in the diversification of asset classes is Bill Gates, who is heavy in the agricultural sector. Rickards is not really against stocks, but he says that one must be selective in choosing the right stocks in relevant sectors. He gives a few examples, such as ExxonMobil, Cargill, ADM, Marathon, and more other than stocks. He also highlights the importance of holding significant portions of cash, most preferably taking up to 30% of your overall portfolio bonds, and treasury notes are some reliable options, including 2 to 5 years in your notes. Furthermore, he adds that when the severe recession finally happens, the Fed will be forced to cut rates, which would make the price of notes too expensive. With this in mind, buying those notes now would be a good investment. Well, that's about it for today's video. Hopefully, your newfound information will help you prepare for the upcoming recession. What are your thoughts on Jim Rickards' view on the upcoming global recession and massive market crash? Let us know in the comments section below. And while you're at it, make sure to smash the like and subscribe buttons down below. Additionally, if you want to know more about Mullen stock, I highly recommend watching this fantastic video. Just click this video right here. Thank you for tuning in and stay tuned for more exciting content in the future.